I picked this paper because I thought it's quite recent, from 2023, and I thought it was really interesting. And also, there's still quite a lot of trend following people around there. And make no mistake, in the institutional finance world, so trend following is still a very big deal, and it's actually run like there's a lot more financial firms that run trend following strategies than there are firms that are running, say, AI strategies. So I thought it would be a very interesting and timely topic. Now, when you look at the authors, Zakamulin and also Gina, they're no small, especially Zakamulin. He's a big guy. He's published a lot of papers. He's quite well known. So usually when you look at what they do, it's fairly thorough. They have some interesting ideas, and they come up with some good stuff. Now, what I want to do is first, I want to go through some aspects of the paper, and I'm not really sure, but there's probably a lot of, as always, a lot of jargon and stuff that a lot of you may not have heard, or it's not really clear what it means. So I want to go through that quite a bit and sort of explain to you all the basic ideas that are combined in this paper, because oftentimes we read these papers, and I feel the same way, and I don't always understand everything that is talked about. And this paper in particular actually combines a lot of these ideas. And so what I want to do is really give you the background as well. And I think actually getting the background can be just as interesting. And you know, when you read these papers, actually understanding them, you learn a lot about many different topics. So if you look at the abstract, the first thing that stands out for me is that sentence: however, all existing trend following rules are essentially ad hoc, lacking a solid theoretical justification for their optimality. This paper aims to address this gap in literature. So what they're really saying is that, you know, trend following is an old thing, and probably quite a few of you have heard of the turtle traders. So they're like this famous trading group back, I think in the 80s it was, that was quite successful. They're also used in early form of trend following. And so trend following is very old, nothing new. As I said, it's been practiced, and it's still practiced by a lot of institutions. And what they're saying here is that there is really not much of a theoretical background for that. And what they actually want to show is that here is some theory, and based on that theory, what we can do is we can actually find some rules that are optimal under certain conditions. And I think that's very interesting, because if we actually think, well, you know, my trading, this is something I want to do, is, you know, trend following, then this sort of practice to actually have a theoretical justification for why you do something is incredibly helpful, because it gives you much more confidence about the things you're doing. Oftentimes, and I don't know about all of you, but when I build trading algorithms or trading strategies, you know, I try a lot of things, and I look at them and I go, okay, this might work, this might not work, but there isn't really necessarily a reason for why this should be the case. So finding underpinning theories about that is definitely helpful. So first, I want to just give you, for those of you who haven't got that background, I just want to quickly talk about trend following. Just as a question, is anyone not really familiar with this topic? If you want, maybe you can always just say it. Well, if you're all familiar, I'll just.
I was just going to say, yeah, I'm not super familiar, but I've seen some papers that have been
okay.
That have been tested, yeah.
Okay. All right. I'll talk a little bit about it. So what is trend following? It's basically uses very simple time series rules to exploit trends. Now, what's important to remember here is that trend following is oftentimes applied to futures, and there is a difference between, for example, futures and equities. Equities are often quite correlated, so mostly equities or stocks, if you will, they have very similar behaviors across the board. And so a logical way to exploit them is to actually use cross-sectional rules, meaning that, for example, if you have a list of 100 different stocks, you rank them in order, for example, of which one has the highest value of, say momentum or something, and then you go long the ones that have the highest, and you go short the ones that have the lowest. It's what you call cross-sectional. However, in trend following, as it is usually practiced, it's done on futures, and it's done in this time series way. So rather than actually saying, oh, you know, we separate into long short based on a ranking, we're actually saying, well, what does the time series on its own tell me? And based on that, we actually put on the strategy. So normally this is a system that is a lot more popular with retail traders, and of course companies that do trend following. Usually that's CTAs, commodity trading advisors, which is basically hedge funds for futures trading. So hedge funds usually are more involved in equities. CTAs are more involved in futures, and so because futures are so diverse, there is often not really a reason for why you should rank them, because they're so different from each other. So what you do is you follow more the time series, and that's mainly the reason why this is used in futures. So the one of the attributes of trend following is that quite often you have very tight stop losses in your trend following systems. So when you actually get a trend signal, and as soon as the signal goes against you in a very small way, you actually exit your trade. And only if the trend persists for longer, you stay in the trade. So if the trade doesn't actually go against you very quickly. And the result of that is that in trend following, often you have a lot lower win rate than in other strategies. So in trend following, you lose a lot, but when you win big. And usually the wins are much bigger, and they outperform all the losses that you may have incurred by exiting early. And if anyone's interested, there's a really good book I like by a guy called Andreas Klanov. It's called Following the Trend. I think it's an excellent book about trend following, and this is, I would say, where I learned a lot of my where I gained a lot of my understanding about trend following. It's also very helpful in learning how to construct portfolios of trend following strategies and so on. So if anyone's interested, check out this book. It's extremely valuable. So the next thing they state in their abstract is, we show that if a Markov model governs the return process, it is optimal to follow the trend using the exponential moving average rule. So I will talk about this a little bit later. However, the Markov model is unrealistic because it does not represent the bull and bear market duration times correctly. It is more sensible to model the return process by a Semi-Markov model, where the state termination probability increases with age. Under this framework, the optimal trend following, blah, blah, blah. So there's quite a lot in here to unpack, and especially the idea of a Markov model. So I will actually talk about this and explain to you what this is and how we can understand a semi-Markov model. And the other thing is, of course, there's different types of rules, trading rules in trend following, for example, the exponential moving average rule. So I will also talk a little bit about this, and I will show you what these rules mean. So first of all, I want to talk about what is a Markov model. And Markov models are quite frequently used to analyze time series. It's basically a machine learning algorithm that detects trading regimes using a technique called Bayesian inference. So when you actually build your own Markov models, they're quite complicated in some ways. They use a number of different types of algorithms, and so setting them up is no easy feat yourself. However, there is a few out-of-the-box packages that can do this, and they're very interesting. So when you look at the chart on the right side, what you can see is this is actually a time series model that has been, and this is actually for Bitcoin USD, but it could be anything, and that has been used with a Markov model. And you can see there is actually it's separated into 3 states. And when we look at these states, we can already see, hey, that they're quite distinct from each other. So for example, we see this red one here. This is clearly a strong correction or a bear market. Well, it's not really a bear market. It's more of a strong correction. Then we see the green state. This is more the type of regular trading we would expect. It's not really a bull or bear market, but it's more a sort of a regular trading regime. And then you can see also here, there's some blue states, very few, and you would probably classify them as an extreme upward correction. So this is a 3-state market. Now, what people in the paper talk about is a 2-state market. And obviously, when we talk about a 2-state market, often we think about a bull and bear market, but that's not necessarily always the case. And you can see this here. You've got this regular market, but in this case, you've got this bullish type market, but then here you also see the green state is a bearish type market. And it's quite interesting because in some sense, or in many cases, actually, we're not necessarily interested in a bull or bear market, but we're actually more interested in, well, is the market a regular type market or is it an irregular type market? Because when we train models, we mostly train them on a regular market operation, but then when the model gets into an irregularity, then it falls over. That's and often if you do this trading yourself, you will have noticed that. So the notion of like bull and bear and so on is not always the ideal way of separating market regimes. Now, what the Markov model does is quite interesting, and this is, we're actually talking about something called a hidden Markov model here. So we can see here's our 3 market states, and oftentimes they're called hidden market states because we don't necessarily know what these market states exactly are. We just infer that there are different states, and the model just separates them in a sort of more or less automated fashion. So there could be bull and bear markets, but there could also be, regular, irregular, and whatever markets. Now, when you normally deal with a hidden Markov model, what happens is you have to actually determine how many states you want. So you could say, well, I just want 2 states or 3 states or 12 states, depending on what you're interested in. And so what we have is we have observed quantities. So we have these states and then we have quantities that somehow characterize in which state we're in. And these quantities could just be, say, market indicators. It could be volatility, volume, maybe an indicator like the relative strength index, or something like, or the high-low difference of the market, similar to volatility. And there's many indicators. And so what this diagram shows us is that there's 2 things. First, we have transitions between these states with a certain probability. So for example, we could go with a certain probability from state x1 to state x2. We could also, with a certain probability, stay in state x1, or we could stay in state x2, which is not really shown here. And then we could go with a certain probability, say from x2 to x3. But as you can see here, there's no return path from x3 back to x2. So once, at least in this diagram, once we're in x3, we're kind of stuck here. But most of the time, obviously in the market, it just jumps back and forth between states, but it's also staying in states sometimes. And then, of course, there is a certain probability that in state x3 we observe a variable y1 here, or y2 or y3, and so you know, each state has a certain probability of observing a set of values, which is also true, right? We have, say, our technical indicators, and a certain configuration or certain image of technical indicators could be much more probable to indicate a bull market than a bear market, for example. So, for example, if the fast-moving average is above the slow-moving average, we're more likely to be in a bull market. But it doesn't mean we're categorically in a bull market. There's just a higher probability of that. And yeah, and so from these observations, what we then do is we try to infer what state is the most likely state of the market. So that's what's called a Markov model. Now, again, if you have any questions, just feel free to jump in and ask, and I'll explain. Okay, now what's a semi-Markov model that they talk about is basically when we build Markov models, often what happens is that we actually switch from state to state it's quite jumpy, so let's put it that way. So there's quite a lot of switching back and forth between different states, and then can make the Markov models sometimes a little bit unstable. And so what this also means is the transition probabilities have a certain value. And what you do in semi-Markov models is basically you say, well, we have certain transition probabilities, but they also depend on how long we have been in a state. So, for example, if we have been, all things being equal, if we have been in a certain state, let's just call it a bull state for 2 weeks, that probability of exiting the state might be lower than if we had stayed in this bull state for 2 months. So what the semi-Markov model does is effectively it introduces a time factor as well that changes the transition probability based on how long this state has been persisting. And in some ways that makes sense. You know, we know that markets are always changing, and there is this time element to them. And that's what they refer to in this paper as the semi-Markov models. Now, in the next step, I want to talk a little bit about trend trading rules. So they're just these simple rules that people talk about in the paper that are used for trend following. And that's also quite interesting because when you read, for example, the Following the Trend book by Andreas Klenov, he actually says that, well, it doesn't really matter that much what rules you follow. They will all more or less provide a similar outcome. And in some ways, he's right. Like, if you have a stable strategy, it should actually show you, relatively stable results, regardless of the parameters. And that's a good thing, because if your strategy is extremely dependent on a specific set of parameters, then what usually happens is out of sample, that will just simply not work. So you want strategies that are quite robust against these changes in your parameters. And then the question is, of course, well, if that's the case, why would we even bother to talk about an optimal trend following rule? Well, it's on one hand, it's true that the strategy should be quite robust. On the other hand, an optimal trend following rule doesn't necessarily tell you, oh, this is the perfect strategy that gives you the highest P&L. But what it does tell you is this is actually the most robust strategy that is actually really useful. All right, so trend following rules, you see, this is probably the one that most people know. It's called a moving average crossover. So when you can see this here, the red line is basically a fast moving average. Slow moving. No, it's the fast moving average. It's the slow moving average. The red line is the slow moving average. The blue line is the fast moving average. And if the fast moving average is above the slow it indicates you're in a trend. And when they cross over, such as here, we should go long. And then when we see that the blue moving average crosses under the red one, and we say, well, we go short, and then we should be in a bear market. And you can see this here. We've got this uptrend, and then we've got this downtrend. Now in trending markets, this actually works really well. And that is basically because, you know, as you can see here, we have this right indication, and then as the trend persists, we're going along with the trend. Now, one thing you can also notice is, for example, if you look at this cross and you go straight down, when this crossover occurs, we already are about 1/3 into the bear market before this cross even occurs. And this is simply because moving averages generally have a lag. And you can see this here, they always lag behind. And that's just the nature of this. There's not much you can do about it. So if you actually look, when we enter this, so we enter it about here, I would say here's the cross, we enter it about here, and then we exit it about here, you can see that in fact, you know, the profit opportunity is really just from here to about here. So it's actually much smaller than the actual trend. And that's just generally the case when we do trend following. We never be able to basically go from here to here. It's impossible to actually catch those tops and bottoms perfectly. So there is another system that is also based on moving averages. It's a MACD. And a MACD is similar to this moving average crossover, but it has another line which is basically smoothing this moving average. And so there's different trend following rules, but basically a combination of this gives you the entry and exit signals. And the paper actually explains quite well exactly how this rule generally happens. One of the interesting things about the MACD rule is that it actually also captures sometimes market reversals to some extent. So it's a little bit more complicated than the simple moving average. And then finally, we have the momentum rule. And the momentum rule is basically saying, well, if we had a certain trajectory of our price series, let's say over the last 12 months, let's say you know, a certain change in the price of this, then we expect that this momentum will actually persist sometime in the future, so a month or 2 months or 3 months into the future. And the stronger the momentum, that means the stronger the slope of this price change, you know, the more we expect this to persist going into the future. So you see, for example, here we've got this stagnation, and then here there's an acceleration where the momentum increases, and then there's a deceleration, another stagnation, and then a reversal. This is a typical market behavior that we can observe. Unfortunately, you know, we cannot just easily say that's always like that, so it's not easy to predict. The other thing I wanted to say is that when we use these trend following rules, and we're actually in one of these, or these moving average rules, or one of these stagnation areas here, they won't work very well. So often in the case when we have this sort of scenario, then this nice moving average usually gets obliterated, and we make quite a few losses in these areas. Now, all this, at least the top two, they're based on moving averages, and there's different types of moving averages. There is a simple moving averages where we basically have a window that slides over the prices and then takes the average. There's a linear moving average where we weight the most recent data, and then we have a linear, or our weights linearly drop off towards the past. So if our window is, let's say, 1 year long, then over 252, say, trading days, the weighting gets smaller and smaller until it is 0 right at the beginning. So basically that means the most recent days get a higher weighting than the past days. And that's actually true for the exponential moving average, only that instead of a linear weighting here, we have an exponential weighting. So it drops off faster going backward in time. Hope that makes sense. Let me know. So you can actually see this here. So this is, you know, momentum, where basically we always have exactly the same weighting. Here we have, this is actually the weighting of a linear moving average. So we can see this drops off. Here this is exponential. And then there's a few others. We have, for example, here the moving average crossover. What that means here is that the weighting is basically highest in the middle, because we've got the difference between the two moving averages. And when they cross over, the difference is really small, then it gets wider, and then it sort of gets smaller again. And if you do the same with crossover with an exponential moving average, then it's more of a curve rather than this sort of triangle. Now, what people use it for is, so if we look at the paper, they do a lot of maths in there, and the maths is, you know, it is reasonably complex. And so what they're actually talking about is, rather than using prices, which is what's normally done in trend following, they say, well, let's use returns, because returns are a bit easier to treat in a mathematical sense. But if we do this, then we have to take into account these weightings to get the mathematical formulation. And this is what this formula shows, is basically got this theta here, then this is some sort of average, the theta is the weighting, and then this is the return. So we're actually, our I is the indicator, we're actually transposing our price-based indicator to a returns-based indicator using these weighting schemes. And that, again, that becomes more important further down when we talk about these regimes. So the next thing they talk in the paper about is auto-regression. And again, if anyone has any questions, please, there's no stupid questions, so feel free to ask. I know it's quite a bit to take in, so I'm happy to explain it to you in more detail. So auto-regression, what this means is that past returns are correlated to current returns. So when we basically draw a chart where we take all the past returns of a time series and then we shift them by 1 day, and then we basically regress current returns against the returns 1 day ago, and we can see that there's a correlation just like this, then our time series becomes somewhat predictable. So let's say there is a correlation, we can say, well, if there is a positive correlation, then we can assume that the returns, yes, or if we had positive returns yesterday, there is a higher probability that we also have positive returns today. That's what's called positive autocorrelation. Now, there's also something called, and this actually positive autocorrelation, another word for that's also trend. So a trend is basically a process where today's returns are correlated positively to yesterday's returns. Now there's the opposite, where we have a negative correlation. So that means that if yesterday's returns were positive, today's returns are more likely to be negative. And when we have that process, we then call that a mean reverting process. So here you see the mathematical definition, basically, of trend and mean reversion. So trend is not just something prices going up or down consistently. It's a bit more, it's a bit deeper than that, and actually it's got a lot to do with the correlation between different returns in different days. And the reason why I bring this up is because the paper uses this idea of autocorrelation, and they're basically saying mathematically autocorrelation and autoregression, which is basically this regression process, are mathematically analogous to this Markov model. So they talk about this Markov model to basically indicate, okay, we have different regimes in the market. And when we have that, we can also say, well, this is actually similar to this auto-regression, which is basically autocorrelation, but for different time lags. So you know, we can have an autocorrelation from today, between today and yesterday, but we could also have an autocorrelation from today to, let's say, 1 week ago. And that's actually, and you would say, well, why would we do this? This is quite important because, for example, the returns or the return behavior of, let's say, a stock this Friday is probably more similar to the return behavior from the previous Friday rather than the return behavior from yesterday. So just looking at the return of yesterday is not always enough. You also want to look at, well, what happened around the same time a week ago or around the same time, let's say, a month ago. So this is where autocorrelation comes in and autoregression, and where that becomes quite interesting. Now, if we don't have any autoregression in the system, we talk about a system that is a random walk. And for those of you who are a bit more mathematically inclined, you probably know that with a random walk, it is actually impossible to consistently make profits. So only if we have some sort of autocorrelation in the system, we can actually make predictions about the system. Okay, so here is a bit of maths for those of you who like it. I talked about the equivalence between the autoregression and the Markov models. And so this is what it looks like mathematically. Here, this is what's called the transition probabilities of the Markov models. So what it means is we have two states, A and B. And so these P's are probabilities that our system stays in state A. This is a probability our system goes from state A to state B. This is a probability of system going from state B to state A. And this is a probability staying in state B. And then we also have probabilities for the occurrence of the state. So that's actually different from this. This is the transition between the states. So you could imagine that just from the slide we have seen about Markov models that, we got a lot more green states than red states. So the probability, say, of being in a green state is a lot higher than of being in a red state. So these probabilities are not just 50-50. And then when we take these probabilities and these transitions and we plug them in this like quite lengthy equation, then we get this rho here, and the rho is basically the slope of our autocorrelation at a different leg. So if we go back, to this slide, this slope here is basically this rho, and so this is the equation that correlates these Markov properties with the autocorrelation. And so this is the mathematical justification for doing that, for those of you who are a little bit more interested in the mathematics. So now this is the figure that probably is really interesting, because what this does is it sums up all the considerations we have previously looked at. So we looked at Markov models, we looked at moving averages, we looked at autoregression. And what this shows is that the correlations of autoregression at different legs are essentially the same as the weights for our optimal trend following rules. So what they have basically done is they have taken those trend following rules and formulations for the returns, and then they optimize them on some in-sample data set. So the data set is, it's quite lengthy from, I think it starts like, it goes over like 30 years or so, up until the 1970s or so. So it's quite a slightly strange out-of-sample data set. But what they've done is have basically taken this, they have done, found through optimization and backtesting the optimal rules for trend following. And what they can then show is that they're essentially the same as the weights from your autoregression. And that's really interesting. So what this basically says is, if we look at the system in terms of the autoregression, we find that they are coinciding with these trend following rules quite well. And that's great, because what this says is that by analyzing these historical data, we don't have to really guess anymore or do like massive parameter sweeps or so to find optimal rules. We can actually use some theoretical considerations, and from those determine the optimal trend following rules quite easily. Now, and when you do this, it's pretty obvious that one could argue that, well, are they actually optimal going forward? And there's no reason to assume that they are, because just what worked in the past doesn't necessarily have to work in the future. And so what they do is, in the paper, they actually show, well, when you do this, they do actually also work quite well out of sample, and the out of sample period is quite long. I think it's over 20 years or so. I need to actually check up on that. But when you go through the paper towards the end, they show, well, actually, these rules really keep holding for a very, very long period going forward. And I think this is really the important part of this understanding of the paper, is that those rules are not just flukes that are somewhat plucked out of thin air, but they're actually really fundamental to the way markets operate. And I think this is really quite fascinating. So what they've actually also done is, here, when they do their optimization of these rules, they optimize it for two different metrics. One is the Sharpe ratio, or the risk-adjusted return, and the CAP-M alpha. So CAP-M, capital asset pricing model, and the alpha, basically, it's a regression where you say, well, the slope of this pricing model is the regression line between your benchmark and the actual trading strategy. And so the slope is the beta. It's basically the correlation between the benchmark and the trading. And the alpha is what you call the idiosyncratic return. And it's the return that can't be explained simply by the underlying benchmark performance. And so there's different philosophies on what you should optimize and what's the best, but they're probably the most common ones. So, of course, I was quite interested in this, and I have done my own somewhat smaller and crude, because I'm a busy guy. I haven't got much time. So all I did is I used the ideas from the paper and I built my own models. And I basically wanted to see whether it actually holds up for what I'm doing in my case as well. And so in this case, I just took about 30 different futures contracts. I used the rules as they were described in the paper. I did some optimizations, and then I applied this in a sort of walk forward way out of sample. And what you can see here is I actually get a pretty decent Sharpe ratio of 1.1. Now, some of you may say, well, 1.1, that's not a straight line from the bottom left to the top right. But actually, this is compared to most CTA performances, like commodity trading advisors. A Sharpe ratio of 1.1 is actually fairly decent. And this is considering that I have really not done any optimization or anything here. I literally just got curious about it, and I thought, oh, can I replicate this? And getting a Sharpe ratio of 1.1 is pretty good. And one of the things you see here is that the strategy has actually what you call a long volatility behavior. So you can see, for example, 2008, it does really well. And you can also see here in 2020, it does a small blip, but then it really goes positive. And this is what you call a long volatility. So it does really well in strong volatility regimes. So as you can see here, initially it's not so good, but then as soon as it picks up on where it's going and picks up on the volatility, it's actually doing really, really well in both cases here, 2008 as well as 2020. And you can see it gets quite flat after that, but it can also see that it looks like it might wants to go back up again. But of course, I can't really tell you because I haven't got the data. I can't look into the future. Anyway, I think it's quite interesting. And what I can see is that I actually use the optimal EMA rule. So they have also an optimal MACD rule, which they reckon is actually even better than the EMA rule. So I haven't had time to do the MACD, so I just tested this, and it worked quite well. I would assume if you use MACD, you probably get even a slightly better performance, but I don't know yet. I can't tell. Anyway, I think it's very interesting. I think that the strategy, even as it is definitely not so bad. What's also good about the strategy is it's got a fairly low turnover. It's pretty robust against transaction costs. And the other thing is you can also use it on pretty high volumes. So you can, you can definitely use it with hundreds of millions of dollars of trading volume. So if you are in a larger fund, then probably quite an interesting strategy. But yeah, I mean, I'm sure that could be even improved quite a bit more, which I haven't done. So that ends the explanatory part of the paper. Now, I do have some comments by Julia, which sent them, and I wanted to discuss them. But maybe before I do that, I wonder if there's any questions from any of you, which which you would like to have answered. Can you see me? Yeah. Okay. So are there any questions from your side? Anything that you want to know? If not, I'll just start with Julia's comments, and then maybe while I discuss them, there might be some of you who want to know something more. So comments by Julia says,
make for sorry.
Go ahead. Yeah.
I was going to ask, what types of optimizations would you make for the futures trading algorithm? I know like seasonality is something that can be involved, and maybe you could have an LLM do some market research and correlate news and that sort of thing. So
yeah, so there's obviously many things that you can do, and like you could use LLMs. I haven't actually used LLMs for those sort of purposes myself, but it starts basically even much more straightforward with some type of portfolio optimization. So there's multiple levels of that. And probably the simplest thing you could do is, first of all, align all your underlying futures contracts and scale them by volatility. So you have an equal volatility of your underlying contracts as you apply the strategy, and that often helps a lot with getting better strategy performance. It's actually, I have done none of that here. So the first thing I would do is actually get a what you call a risk parity, or like volatility alignment. And the other thing that you can then also do is another volatility alignment as you see the performance of the strategy. So you can actually then correct your volatility going forward as you observe the strategy performance, because that often actually generates a different type of volatility. Now, the next step from that is, say, for example, a mean variance optimization, which probably could make things a little bit better, but there's also very well-known problems with that. The next step is maybe using neural networks to do portfolio optimization. So that's something I've been working on. I've even got a little course out on using neural networks for portfolio optimization, basically using the Sharpe ratio as your loss function, and so on. So there's many ways you can do this. There's also things where you could say, well, in certain regimes, I'm staying completely out of the market. This could be, for example, also driven by Markov models, where you can say, well, these regimes are not really suited for my trading style, so I'm not actually trading there at all. I'm just staying out of the market. Does that answer your question a little bit, or is there anything more you would like to know?
That's great. I think there is quite a bit out there. It's just
there is, yes, and I mean, I mean, this is my job, futures trading and developing strategies. So there's a lot to talk about. I could talk about this for days and completely geek out, but of course we haven't got the time for that. All right. Any more questions for now? Anyone else? If not, I might just jump over to Julia's comments. She actually left some really interesting ones. So the first, she makes 4 points. So the first point, she says, it seems that the indicator is based on returns estimated by ARMA. And ARMA is an autoregressive moving average model. So it's basically the autoregressive model I've been talking about, despite the challenge predicting returns in general. So one thing she says is that what she basically says is that ARMA models are not really suitable for predicting returns, and she's very right, because ARMA models are not these days used anymore for actually doing any return prediction. However, the ARMA model in the case of the paper is actually not used for return prediction. It's actually used just to find the optimal weighting parameters of your model. So that's quite a different type of approach. So she's definitely right in the way that ARMA is not good for return prediction, but to actually weight your trading or weight your trading indicators in this way to find the optimal, then the ARMA model, in my opinion, is definitely a lot more robust. So unfortunately, I can't ask Julia for her comments. I wish I could and say stuff back to me, but I hope maybe we can have a discussion later somewhat, and she can see what we're doing here. All right. So the second comment, she says, according to the literature, momentum performance is strongly impacted by bear markets during which intervals momentum breaks. Standard time series momentum hence mitigates this with volatility scaling. Note, this component is missing in the paper's description of the standard momentum strategy, and 2, predicting volatility is considered more optimistic than returns. All right, so I already talked about this, and I said, oh yeah, volatility scaling, the stuff I just explained is a very standard practice, and that you do this. Now, the paper doesn't discuss this because I think it's actually not really relevant in this case. It would add even more complexity to the paper, which is already fairly complex. And volatility scaling is really more related to improving the performance on a portfolio level. So that wasn't really the point of the paper, in my opinion. So I would say, well, you could not leave this out. So I think it's a good point, but the paper isn't really discussing this. And then she says on her second point, predicting volatility is considered more optimistic than returns. Now, again, we're not really predicting returns here. it's true, volatility is generally easier to predict than returns. Why is that? Because volatility has a much strong mean reverting property. And so generally there is an easier prediction, but what she refers to is that an ARMA, she basically alludes to using the ARMA model to predict the returns, which is actually not what's happening in the paper. And so for predicting volatility, there is a similar model called the Gauge model, which is called generalized autoregressive heteroscedasticity. Complicated. And so she assumes that we use the ARMA to predict, and then we use the Gauge model to predict volatility. But I think this is not really, in some sense, the point of the paper. So I would say, well, good points, but the paper doesn't discuss this so much. Now, her third point is the paper, however, looks to use common weights for the bull and bear markets. Then it would be interesting to see their prediction of the bull-bear switch. Now, I'm not really sure what she means with that. I don't think they really talk about bull-bear markets. They just talk about using general weights for the market regimes and why you would use those weights. And basically the point is that when you actually use what they call an optimal switching mechanism with a Semi-Markov model, which is similar to the MACD model, then that actually addresses the idea that you have these bull and bear regimes more strongly. So I'm not fully understanding this point, but I would say that I don't think they're really looking at a switch from bull-bear. Quite frankly, I don't think, in my humble opinion, it's actually very easy to make these predictions in any case. And you've seen that, for example, if you use Markov models, they don't necessarily predict whether it's a bull or bear market, but they might actually tell you, oh, it's a regular market or an irregular market rather than a bull-bear. So the bull-bear assumption is a very simple one, and I think in many cases, if you want to have successful trading strategies, you need to be a little bit more nuanced than just actually separating the market in bull-bear. I mean, of course, this mostly applies to my own personal experience and to fully systematic trading. However, if you are more of a discretionary trader, then that's a very different story. So I just want to say here as a caveat, that's not what I'm talking about. And then finally, the choice of in-sample 1875 to 1974 and out-of-sample 1975 to 2020 intervals looks a bit odd. As a result, they not only ignore the impact of economic and technological changes, but it also seems this provocatively imply zero impact from economic research on practical applications. Good point. I think also that the choice of the in-sample, out-of-sample intervals is a bit odd. However, I think what I tried to show in the paper is that even if you choose this very odd intervals, it still seems to produce reasonably good results. So they actually use a 45-year out-of-sample period. And I think their point was to show, even if you use something like this, you can still actually make an inference about or can make some predictions about the market going forward. And I guess what I tried to say is that despite all the technological changes and the impact of the new economies, you could still argue that the market hasn't fundamentally changed in a big way if you zoom out quite a lot and you look at it on a very large scale. So I think it's a really good point she makes, and I'm not here to defend the paper in any way. I'm not saying, oh, the paper is like right or wrong, but I would say their point of actually choosing these dates was actually to make a point to say, well, look, despite all these changes, we can still end up with a quite robust strategy that holds up for 45 years. And so what I've done in my test was actually use a walk forward optimization in sample out of sample. So it's a bit different, but it just works very much in a similar way. So that was basically the comments. So I'm wondering if there's any other comments, or even if you have some questions that may not be perfectly related, feel free to ask them. And if not, then we're ending the session here. Thanks for your attention. Thanks for your question. Oh, there's one. Dennis, go for it. Oh, Dennis. Oh, Dennis and Richard.
I think he was just waving.
Yes, thank you.
Oh, okay. No problem.
Tom, I have a question with how you might obviously this paper has been designed around equities trends and an optimal 10-month periods and looking at bull bear in that sense. You've applied it to futures markets, commodities markets. How have you found the bull bear differentiation there in terms of periods and percentage in each and length of bull bear in the futures, especially commodities area, versus the ones described in the paper?
Yes, it's interesting. Like I find that actually making, on a global scale, making the case for a bull bear market per se is probably a bit simplistic, and I find that actually having a bit more nuance in that is quite useful. Now they're basically talking about a two-state regime, and what they're not saying is that this is actually a bull-bear regime, or they don't even say it's a mean-reverting trending regime. All they say is we separate the market into two regimes. So people implicitly assume that when you have two regimes, there should be bull-bear regimes, but it could actually be that it's a regular and an irregular regime. So, you have a market that trades in a regular fashion, and then you have a market that is just like in a correction phase or something like this. And quite frankly, I think this is a much more a useful assumption, in my opinion, than saying bull market and bear market, because when you're trading fully systematically, a lot of the trading strategies that you have are not necessarily centered around that. The other thing is that when you look at equities, equities usually equities on average tend to go up because companies generally add value to society, whereas a lot of the futures trading is more of a zero-sum game. So for example, commodities are not value-generating assets. That they are what they are, and currencies definitely are not generating any value. So a lot apart from equities, most of the other things are zero-sum games, and so when you trade futures, making this distinction between bull and bear markets is also a bit tricky because of the fact that in many cases they are trading in quite a different way to equities. You can really see that equities have this behavior that sort of value adding behavior. You could just look at the S&P 500. It's usually going up, and then it's got these times where there's phases of correction, and then it goes up. And if you look over the 100 years, it's pretty obvious. Now futures really don't have that. So you have to actually really look at this through a different lens. It's important.
Absolutely. I mean, the equities markets in themselves, if you look at an index, that it's already a momentum system.
It is a momentum system, yes.
The S&P 500 is a survivorship bias of the top 500 at that time, and anything that doesn't qualify, drops out, and it's gone. Same with total market returns. We obviously when a company delists for whatever reason, it's gone. If it's no longer tradable via normal means, we don't have to consider its eventual demise. Whereas the futures market, well, you don't have that. So I think we, looking at equities, you need to always consider its, equities indices and total market returns. They are already full of survivorship bias, so we need to view them with that sort of skew.
I fully agree.
The other thing, of course, is we have a continuing amount of retirement funds being poured into the equities market. So it's being invested somewhere, and so you've got the printing press of retirement funds just propping the market the whole time. So whereas futures, well, no, not. We consume them, consume the commodity. So,
not to forget the printing press of the Fed.
Yeah, exactly.
Quite a printing press, and I fully agree. It actually seems like really simple to trade equities, but actually there's a lot of like when you come at from a systematic standpoint, there's a lot of things. It's actually a lot more complex than most people think, even though it seems easy. And you're also right, specifically the S&P 500 is pretty much a momentum strategy, whereas the Russell I think the Russell is equally weighted, and that works quite in a different way, right?
It's not actually. It's free float market cap weighted. So
it's market cap weighted as well.
Yeah, but it's only rebalanced every year. So it's a I guess a longer term momentum system. So you can get quite dramatic movements intra-year. So
it's interesting actually when I often look at the S&P equally weighted index versus the S&P market cap weighted, the S&P 500, and it's actually just looking at that there's some fascinating insights to gain just from looking at behaviors like this. So
the Magnificent Seven.
At the moment,
skewing everything.
It's pretty interesting, but also I mean futures are fascinating. Or the behavior of different futures is quite fascinating too when you go into the details and the differences between the different underlying asset classes in futures. Let's just say metals, oil, or energy, currencies, and so on, or even equity indices. You can see that there are some very specific market-specific behaviors which can, in some cases, be exploited specifically. Now, what's interesting in the backtests I've shown you is that I just did this whole thing across the board, and I really didn't put any fancy anything in there, and surprisingly, it did quite well. For when I normally set up stuff like this, I wouldn't expect to have an outcome like this just on the first setup. So that prompted me to say, well, actually, there's really something in this paper. Like it's quite interesting. And as I said, I haven't done much work on that. I just looked at it and I'm like, oh, okay, that's better than I expected. So that was the fascinating part of this. And when you talk to a lot of people in the CTA world, for example, like their trading strategies are often so quote unquote stupidly simple. It's just like you think, well, they're all like these automated traders. They should be like really sophisticated and use a lot of machine learning. And in reality, most of them actually use very, very simple trading strategies. So that's also something that shouldn't be forgotten, that a lot of the professionals, they are not necessarily going for the really complex machine learning systems, but for the actual simplistic systems, because they often have proven to be really, really robust over long timescales. And also the other thing that I want to mention is what I said, that specifically this strategy has this long volatility behavior. So what that means is it's actually providing a really good hedge for example, if you have another equity strategy running, if you run just the S&P 500 and you look at this, it actually provides a really good hedge for correction phases in equities as well, because it's got this long volatility edge to it. So I think this is also something that's quite interesting and noteworthy in this type of strategy. So I'm not here to defend this paper. I just wanted to present it to show that it's very interesting. And, that's my main objective here. Awesome. Anything else? Anyone? Well, if not, then thank you so much for listening in. I hope you enjoyed it. And I hope to see you again sometime soon. Thanks, everyone.
Thank you very much.
Thank you, Tom.
Bye.
That was great.